How can one three-digit number have so much impact not only on what we pay in interest to borrow money, but also how much we pay for auto insurance as well as homeowners insurance? Welcome to this webinar, Your Credit Score, where we will address how this score is developed and how you can use it as a tool regarding your financial well-being. My name is Sylvia Watford. I am a senior financial education specialist with Virginia Credit Union, and I will be your presenter. Please reach out to me at sylvia.watford@vacu.org should you have any additional questions after attending this webinar. We will focus on the scoring model so that you can understand what is sometimes referred to as the method to the madness. But what I want you to do is gain the insight so that you can understand how scores are developed, how they're computed, and how they are used by financial institutions, by insurance companies, and how you can also use it as a tool to simply address your financial well-being. So this three-digit number, your credit score, those three digits are designed to simply measure risk by answering one question. How likely will this person pay this loan? The credit score is based on information that is in the credit report. So with that information, the credit score is designed to address that question regarding the risk that a financial institution, that an insurance company is taking to determine a decision regarding whether or not they will approve a loan, if so, what the interest rate will be, or whether or not they will approve any type of service. So that three-digit number, again, is associated with risk. The scoring model that we will focus on is the FICO score. Over 90% of financial institutions use the FICO score when they are making decisions. This score was developed by two men, Bill Fair, an engineer, and Earl Isaac, a mathematician. They asked the question, what if we could develop an algorithm based on consumers' behavior reflected in their credit report to determine the risk and assign a number to that? They came up with this model, and the range is from 300 to 850, which means if I have a high credit score, there is less risk involved. So my interest rate will generally be lower. Whereas if I have a lower credit score that's associated with a higher risk, so my interest rate may be higher as a result. Let's look at the five components that make up the credit score. As you can see, the largest component is payment history. That makes up 35% of the credit score. 30% is based on amounts owed. 15% is based on the length of credit history. 10% is based on new credit. And 10% is based on the types of current credit. Let's look into more detail regarding each one of the components. 35%, remember, is the largest component, and that is based on payment history. So this simply looks at how we are paying our creditors and how we have paid them on in the past. Keep in mind that this component makes up, again, the largest component at 35% and is based on the most recent activity. Generally, negative information will stay on our credit report for 7 years, with the exception of a Chapter 7 bankruptcy, which stays on the credit report for 10 years. So with the passage of time, any negative information does not have as much of an impact on the recent information on our credit report. In the midst of COVID-19, one of the options that are available for consumers is to get a weekly copy of your credit report at annualcreditreport.com. Many financial institutions are offering forbearances or deferrals in terms of payments. When you reach out to the financial institution and you're able to get a deferment or a forbearance regarding paying the loan, then that financial institution generally they will report that as paid as agreed. So you want to be looking at your credit report to make sure that it accurately reflects what is going on in terms of your credit. So keep in mind, the largest component, the most recent activity has the greatest impact. 30% of the credit score is based on the amounts owed. And this is what we call the utilization ratio. And that is simply how much of my available credit am I using? So if you have a credit card that totals $10,000 and you're using 9,999, you're almost at the limit. That is going to bring your credit score down. The rule of thumb is that we don't want to have a balance more than 30%. 30% or less would be ideal. But depending on your situation, that might not be the case, but that's the rule of thumb, 30% or less. Some of you may have heard, well, should I close out a credit card and will that impact my credit score? Let's look at an example. Suppose you have two credit cards. One, you have a balance of $3,000 and you have a credit limit of $5,000. The second credit card, you also have a balance of $3,000 and you have a credit limit of $5,000. So your total balance on your credit cards would be $6,000, right? The credit limit would be $10,000. So your utilization ratio would be 6,000 divided by 10,000 would be 60%. Now, say you actually get $3,000 and you decide that you are going to pay off one of these credit cards and you are going to close that credit card. If you do that, you'll have one credit card remaining with a $3,000 balance and a $5,000 limit, and your utilization ratio is 60%. However, if you were to leave that other credit card open, then you would have two credit cards with a credit limit of $5,000 each. So your total available credit would be $10,000. You would have the one credit card with a balance of $3,000, but if you paid off the other credit card and left it open, now you have a balance of $3,000 compared to an available credit limit of $10,000, and now your utilization ratio is down to 30%. So that example provides you with the tools to see how closing out a credit card can, in fact, impact your credit score. The next component is length of credit history. Generally, as I said before, any negative information will drop off of your credit report after 7 years. Chapter 7 bankruptcy will be 10 years. But anything that I pay as agreed, the good thing about it is that it will stay on my credit report 10 years from the date of the last activity. So when we look at the length of credit history, the longer that I've had credit, that will work to my advantage because that shows that over a longer time period, we've been able to manage credit. If I have a short credit history, that could work against me in terms of the components. The length of credit history also looks at the average length of credit history that we have in our credit report. So this actually looks at every piece of credit and takes an average of the length of that time period. So that is one of the reasons why we want to keep older credit on our credit report, and we want to keep that open for that time period as well. 10% of the credit score is based on new credit. So every time you apply for new credit, that impacts your credit score. Generally, if everything else is the same, the credit score will drop, and usually within 30 to 60 days, it will rebound again. So any new credit does in fact impact our credit score, and that is what is called a hard inquiry. So keep that in mind. Now, if you are shopping for a large ticket item, if you're shopping for a mortgage or for a car loan, you want to get the best possible interest rate. So what you want to do is you want to confine your shopping into either a 14-day, a 30-day, or 45-day time period. There are different credit scoring models, but the key is confine your shopping to a short time period. If you do that and you shop a couple of mortgage lenders, it will count as one inquiry so that it won't have as much of a negative impact. Because as a savvy consumer, you're shopping, right, to get the best possible interest rate. 10% of the scoring model is based on the type of credit that we actually have in our credit report. So you want to have a variety in terms of mortgage loans, car loans, credit cards, and also you want to look at who you get those loans with. You want to stick with reputable organizations such as credit unions as well as banks, and that will help in that particular category. So that is 10% of the credit score. If I have a low credit score, which is why I want to work to increase your credit score as much as possible, you want to work towards increasing that credit score because the lower my credit score, remember we mentioned earlier, the higher the risk associated with that, and therefore the more you would end up paying in terms of interest. I Research actually shows that if someone has a low credit score over their adult life, they can end up paying about $250,000 more than someone who has a high credit score. So the impact of that low credit score unfortunately can cost money over the long term. So, how do we improve that FICO credit score? Just by knowing the different components that we just talked about, we can apply that to determine things that we can do to improve our credit score. The first component is the payment history. So we want to make sure that we pay things on time. If we cannot make the payment on time and we are experiencing a financial hardship, which many people are experiencing as a result of the COVID-19 pandemic, that is why it is so important to reach out to your financial institution to make arrangements to possibly defer that payment, which means you wouldn't have to pay it for maybe 1, 2, 3 months. And during that time period, it will not negatively be reported on your credit report. It will still show as paid as agreed, which is also why you want to get that copy of your credit report and be looking at that on a consistent basis. The other thing, of course, is just paying down existing debt. We talked about the utilization ratio. So if I can pay down existing debt, that is going to help as well. Having that diversification regarding the types of credits that we have is important. And again, 1 out of 5 credit reports the FTC reported had errors on the credit report. So we want to be checking that credit report on a regular basis and keeping old accounts because that is going to help in terms of the length of time that we have credit. In terms of balance transfers, just be careful in terms of balance transfers because remember, every time we apply for credit, that counts as the inquiry. That could bring our credit score down. And then also in terms of the length of time that I've had credit, if I get a balance transfer, then that will be considered as new credit. So the average length of credit may reduce as well in terms of that time period. Be aware of excessive credit applications. You want to apply for credit when you have a need, and then most importantly, just be patient. Be patient with yourself as well as the process. Because even if your credit score goes down, with time, you can implement some strategies to increase that as well. Please be aware of credit repair companies. When I was working with individuals on a one on one basis, I remember a gentleman who called me and said, Miss Watford, this guy called me and he said for $450 he could clean up my credit report. He wanted to buy a house, and the man told him for $450 he would not have to worry about anything. He would clean up his credit report. And so he asked me, did I think if that would be a good idea? What I shared with him is that if there is anything on his credit report that he did not agree with that would negatively impact his credit score, that he could follow the dispute process to have that information removed, and that would not cost him anything. But what I also shared with him is to remember that there is no legal way to remove accurate negative information from the credit report except by the passage of time. Remember, 7 years generally for negative information, 10 years for Chapter 7 bankruptcy. After that time period, that information should be removed off of the credit report. Now, can you ask a creditor to remove information? A collection agency to remove information? Yes, that creditor or that collection agency, they can choose to remove information from the credit report, but that is the only way in terms of having information removed. So remember, no legal way to remove accurate negative information from the credit report. So please be aware of these credit repair companies that say that they can improve your credit score. With the COVID-19 crisis, we are seeing so many scammers that are promising so many things. And if it sounds like it's too good to be true, it usually is. So please be aware of those credit repair companies. The Vantage Score. You may have heard about the Vantage Score. The Vantage Score is gaining some visibility because of the fact that it is the score that the three credit reporting agencies, Equifax, TransUnion, and Experian, of course, they've been using the FICO score up to this time period. And as I said before, more than 90% of financial institutions use the FICO score. So that is the most popular FICO score. So the credit reporting agencies use that score because that's what financial institutions are looking at. And they actually have to pay FICO to create that score. So what happened is that the three credit reporting agencies, Equifax, TransUnion, and Experian, they came together and said, let's develop our own scoring system. So they developed the Vantage score, which the range is from 300 to 850. They also issue a grade, and the components look similar to the FICO score, but there are some differences. Again, most financial institutions use the FICO score, but for informational purposes, I want to make sure that you're aware of the Vantage score as well. As you can see, 30% is based on recent credit, 28% is based on the payment history, 23%, as we talked about the utilization ratio. The component also looks at 9% based on the balances, 9% based on the depth of credit, and that is just simply the length of time that someone has had credit, and 1% is based on the available credit. So just keep that in mind. The Vantage score is out there. Again, over 90% of financial institutions, they use the FICO score. There are other scores that I want you to be aware of as well. One is called the bankruptcy risk score. What happens is that this number is based on the likelihood, based on information that's in the credit report, if someone has a greater likelihood of going bankrupt. And so that is included in the credit report, and that is a scoring model as well. The other scoring models are internal scoring models that creditors create. So even though you have the FICO score and you have models for that, a specific creditor may want to weigh heavily on a particular items. So they may actually tweak that FICO score for their particular situation based on what their needs are for that particular organization. So you have the internal credit scores from the creditors. And then you also have what is called the non-traditional scores. And this is when the score is determined based on non-credit information. So this may be based on how someone has paid their utility bills, their rental bills, their non-traditional, which could also include in terms of their phone bills. So that's an option as well. You may also have heard of the Experian Boost, which Experian offers in terms of their scoring model. And what this does is that it allows consumers to link their checking account activity so that they can really transfer the information regarding their payment history concerning those non traditional options, the utilities, the rental, the different non-traditional items, the cell phone, all of those, that is considered the Experian Boost. So that's a way that you can connect your checking account, have that information come in and actually impact your credit score in terms of the Experian Boost. So that is something that you might want to consider. What about obtaining your score? Generally, and in the past, most consumers had to pay to get that score, primarily that FICO score. What we are seeing now is that there are a lot of companies that market directly to consumers to have them pay for the score, or they say they give them a free score. Just be aware of what type of score you are getting. If it is a FICO score or if it is a Vantage score, and they will normally disclose to you if it is for educational purposes only. So just be aware that the score you may purchase or receive from those organizations may not necessarily be the same score that a lender is looking at when they make a decision regarding your credit. Also be aware if there is adverse action based on information in your credit report and your credit score, that you can also get a free copy of your credit score as well. One of the benefits that Virginia Credit Union does offer members who have a checking or a loan with Virginia Credit Union and they use their mobile app, they can get a free access to their FICO score, which is used for monitoring purposes. So having your score just allows you to be aware of where you are in terms of that range, that 300 to 850 range, to give you a gauge of where you are, and then you can determine the areas that you want to focus on in terms of improving the score. You always want to be aware of the score, but there are some times, depending on where you are financially, where your score may not have as much of a priority based on what you are experiencing. So if you have a really good score, you have an excellent credit score, and say your score is 840, the maximum credit score is 850, then you really don't have to be overly concerned in terms of your credit score. Also, if you're in a situation where you have made all of your major purchases and you don't plan to make any major purchases, it may not have as much of a priority to you. If you are experiencing financial challenges and financial hardships, remember that it is a season that you may be going through. So as you get through that season, you may have a situation where your score may decrease. But remember that over time, you can rebuild that score as well. If you need to speak with someone on a one on one basis, please remember that this resource that Virginia Credit Union has partnered with Balance is available to you in terms of free financial coaching, which allows someone to meet with you by phone and review your credit report, review your credit score, give you some tips in terms of things that you can do to improve your credit score as well. So please reach out and use this resource. Also, again, my contact information is sylvia.watford@vacu.org. You can reach out to me as well, and I'll be more than happy to address any questions that you have. Thank you so much, and thank you for listening.